Hello everyone. Today we're starting about learning about a very important foundation concept of accounting, which is accounting concepts. And on the basis of this, the entire accounting course is laid down, and the entire accounting is based upon these concepts. So before we start actually going through the accounting part, it's important that we understand the concepts on which the accounting principles are laid down. The first and the most important principle in the accounting is referred as business entity concept. Now, this is the most important concept in the accounting, and the entire accounting is being based upon this concept. Now, what is this concept is all about? This concept talks about that the owner and the business are two separate entities. So, the owner, which can be a shareholder, which can be partner, whatever form of business organization it is, the owner, which is here, and the books and the business, they both are separate. So owner and business are separate entity. They are two different entity. And because of this, we are preparing accounts. We are preparing a financial statement, not for the owner, but we are preparing a financial statements for business. So financial statements or books of accounts are being prepared not for the owner, but for the business. And business and owner are different. So in the accounting language, we are actually preparing the books of accounts for the business, not for the owner. So what does it mean? Let's assume that this is a company which is owned by, let's assume, Mr. A, and Mr. A has created a business with the name which can be called as, let's say, ABC. Now, if I want to estimate how much profit or loss ABC has made, I will prepare financial statements for ABC, not for Mr. A, which means we'll only record the expense only of the business, not of the personal transaction. So I have to keep separate record for business transaction and for the personal owner transaction. And if I have to estimate the profit and loss, I am estimating profit and loss not from owner or Mr. A in this case, but I am estimating profit and loss for my business. And the business is ABC. Therefore, I want to know how much income ABC, the business, has earned and how much expense the business has earned. And which means only then I can estimate what is the profit or loss business has made, which is a separate from the owner. And I'm preparing the accounting record only for the business, not for the owner. And the business and owner are two separate entities. Now, what does it mean because of this? What simply it means that whatever amount the owner is bringing to the business. Now, someone can ask how it is recorded in the books of transactions. So, whatever amount of money which owner brings to the business. So we are the owner of the business because Mr. A must have given some amount of money to this own business. Technically, the money which is given by owner is called as capital. So whatever money is given by owner is called as capital for the business. So in the business, so in the example which you have taken before, in this example, Mr. A is bringing some amount of cash to start the business. So let's assume that Mr. A is bringing $10,000 to start the business, which is ABC. Now, when I'm recording the books for the ABC company, Mr. A has given this money to the business. So in that case, we'll prepare many financial statements. One of the important financial statements which we'll prepare, which we call the balance sheet. Now in balance sheet, we know, we'll discuss that in detail later on. There are two heads, which are one is assets and the other is liability. Now what is the liability? Asset? Asset what? Something which business owns, and liability is something which business owes to the other. Now first liability which the business is incurring here is that business which is ABC. I am preparing balance sheet for not Mr. A. The balance sheet has been prepared for ABC firm, and this ABC firm is getting this money from Mr. A, and therefore ABC Limited, the ABC firm, is liable to the owner, and whatever amount of money which Mr. A is given, which is a promoter, that will be shown as a liability in the balance sheet. So whatever amount of money which is contributed by the owners, now these owners can be individual in a sole proprietorship. These owners can be a partnership, bringing more than one member coming into that, or it can be company where there are large number of shareholders coming and bringing the money in the business. So all that money which has been given by the owners, by the promoters to the business will be showing this amount of money as a liability. Why? Because the business and the owners are separate. So business now is a separate entity. Virtually how it has been seen here is that somebody, Mr. A, is giving them to this money. So as a business, I owe this amount to Mr. A. And that's the reason why capital is shown as a liability in the business. Which also brings to a very, very important concept that from the capital which the money which the owner has given to this business will earn some profit. Clear? So this business will earn some profit. Now technically this profit belongs to the whom? This profit belongs to the owner, right? And therefore what eventually will happen, so let's take an example. What eventually will happen that if the second example which is happening, which is, as I mentioned, Mr. A has given $10,000 to a business which is named as ABC. Let's claim it ABC Limited. I am preparing balance sheet of ABC Limited. And in a balance sheet, as I mentioned, there's an asset, there's a liability. And the first liability which the business is incurring is the amount of money which is coming from Mr. A. Therefore, this amount of money is shown as a liability as $10,000. From this amount of money which the owner has given to the business will start doing it. They will generate some income, they will generate some expense. Eventually, a couple of things may happen. Either the business will earn some profit. How will they earn some profit? The total income is more than what the total expense which have happened. Only of the business income. The business will earn some profit. Now this profit belongs to whom? This profit belongs to the owner, which in this case is Mr. A. Now, therefore, the profit will be added back to the capital. Why the profit is getting added back to the capital? Because initially $10,000, this was the amount of money which the business owes to the owner. Now the profit has been earned on the same amount. It's a reward to the owner, and therefore, unless and until if the owner is not withdrawing this money in the form of a dividend or a drawings, this profit is also added back to the capital. A very, very common question which is always asked, why profit is shown as a part of a liability? Profit is shown as a part of liability. It is because of this principle of separate entity principle or a business entity principle, where the owner and the business are separate and the business is liable to the owner. The company and the firm is liable to the owner for the amount of money which they are given in the form of capital. And from the capital, whatever profit is also earned, that also the business is liable to the owner. Similarly, if tomorrow, if the business starts incurring loss, for example, this company incur a loss of, let's say, $100. In that case, now this is very, very important. Loss, we'll see that later on also. Loss technically is shown on the asset side. Now somebody will ask question, oh my goodness, why the loss is shown on the asset side? Does the business want that more loss should increase? Yes, because business is now asking from the owner that you owe that amount to me. Business is asking this amount of money that Mr. A, you have to give this amount of money because you were running the business, you were the owner. Therefore, business is now asking this money from Mr. A. And therefore, for business, this $100 becomes an asset. And therefore, loss which happens in the business technically becomes the part of the asset side of balance sheet, and a profit which happens in the business is becoming a part of the liability side, which is added to the capital. One can show, and we'll see that in the further videos, that instead of showing as a loss as separate $100, I can also say, okay, $10,000 you contributed. Because you have a loss, and loss I can show negative profit. Therefore, I am reducing your capital by $100 because this is the loss you have suffered. So now business owns not $10,000 to the owner, business will own $9,900 from the owner. So this is another way of showing it, but technically I can say that profit becomes a part of a liability and loss become a part of the asset side. So this is very, very important concept. People still have many confusions about it, and this is just because of very one important principle, which is a business entity principle. This also happens that I keep a separate transaction for business and a separate transaction for the owner. So whatever private transactions are happening or personal transactions happening by the owner, that is not to be part of this business, and unless and until if the owner is using the money of the business, it is technically called as a drawings or the withdrawing from the capital. So this is a very, very important concept, and the entire accounting is based upon this principle that the owner and business are separate, and we are preparing financial statements not for the owner, we are preparing a financial statement for the business. So, and therefore, important another learning is that capital becomes the first liability for the business because this is the money which the owner has given to the business, and therefore whatever you earn from the capital, which is profit, also become a part of the liability which is added back to the capital, because now the business owns more to the owner. And similarly, if there's a loss, the business now asking from the owner that you need to pay about that loss. Therefore, technically, the loss becomes a part of the asset. So this is a very important principle in the first very, very important principle of accounting, in which the accounting concept is laid down. So we'll continue discussing about more accounting principle and concept in subsequent videos. Thank you.